At some point in life, we all think about buying life insurance. And then we hear terms like endowment plans, money-back policies, term insurance, and it all starts sounding like a big financial puzzle. But here's the truth. If you're not careful, you could end up buying something that's neither good insurance nor a good investment. So today, let me tell you why you should never buy an endowment or money-back insurance policy and what you should do instead. Let's start from the basics. There are three broad types of life insurance policies most commonly offered in India. Term insurance, this is pure life cover. You pay a premium every year, and if something happens to you during the policy term, your nominee gets a large lump sum. If nothing happens, the policy ends, and you get nothing back. That's it. Simple. Endowment plans. These are a mix of insurance and investment. You pay a much higher premium, and at the end of the policy term, if you're alive, you get some money back. If you're not, your family gets a payout. Money-back policies. These are just like endowment plans, but here, you get some money back every few years during the term of the policy and the rest at maturity. Now, this might sound good, like you're getting your money back and staying insured. But here's where it gets tricky. Let's talk about returns. Most endowment or money-back policies give you an average return of 4% to 5% per annum. Yes, you heard that right. Just 4 to 5%. And that too before tax. That's even lower than what a fixed deposit or a PPF would give you. Worse, the premiums for these policies are very high. Let's say you're 30 years old and want a life cover of 1 crore. A term plan might cost you just $10,000 a year. But a similar endowment or money-back policy giving the same cover, easily 3 to 4 lakhs a year. That's 30 to 40 times more. Why such a huge difference? Because in endowment and money-back policies, you're not just paying for insurance, you're also investing. But the investment part is giving you very poor returns. And the insurance part is so minimal, it's barely useful. So what should you do? Here's the golden rule. Insurance is not an investment. Keep the two separate. You need insurance to protect your loved ones in case something happens to you. That's it. And for that, the only policy you should ever consider is a term insurance plan. It's simple, low cost, and gives you high coverage. Let's say you buy a term plan with 1 crore cover. You pay around $10,000, $15,000 per year, depending on your age and profile. That's it. Now, with the money you save by not buying an expensive endowment plan, you can invest in mutual funds, PPF, or even FDs, depending on your risk appetite. This way, your insurance need is taken care of, and your investments actually grow your wealth. Also, remember, insurance companies and agents often push endowment and money-back policies. Why? Because the commissions are high, sometimes as much as 25–30% of your first-year premium. That's why these plans are aggressively sold, not because they're good for you. So the next time someone tries to sell you an endowment or money-back policy, ask them this: what's the return I'll get? If it's just 4% or 5%, is it really worth it? Let's wrap it up. If you truly care about your family, buy a term insurance policy with a large enough cover. And if you want to build wealth, invest in proper investment instruments separately. Don't mix the two, because when it comes to life insurance, simplicity is safety, and that's what you should aim for.